Archie, I'm not so sure that everybody needs a Roth IRA.
Well, Rob, let me convert you. I'm Archie Hoxton.
And I'm Rob Hoxton.
And this is Last Paycheck, weekly wisdom to help you retire and stay that way. Welcome back to the Last Paycheck Podcast, brought to you by Hoxton Planning and Management. We're your hosts, CFP professionals Archie Hoxton and Rob Hoxton. And today, we're going to talk to you about Roth IRAs, 401ks, and really about building your Roth tax bucket. You know, we've talked about tax buckets in the past as a way to give yourself flexibility and control over your retirement income and your taxes. And Roth is probably one of the best, especially when we talk about certain strategies to get as much into that bucket as you can. So that's what we're going to talk about today.
All right, so Archie, I'm the old guy. I'm going to talk a little history.
Yeah.
So the reason they're called Roth, they're named after William Roth, who's a senator, Republican senator, who came up with the idea. And that was back in the late 90s. The Taxpayer Relief Act of like 1997 or 8 or something like that. And financial advisors are crazy about this idea, and they have been for a long time. And now we're starting to see a lot of content on the internet about Roth IRAs. And so we thought it might make sense to talk about it a little bit. One of the great stories that we've been actually asked by a viewer of the show wanted to know how he could be like Peter Thiel and get $5 billion in a Roth IRA.
Yeah. Well, and that was probably, I mean, I would argue, at least to my knowledge, that's one of the greatest financial moves in the history.
If it's true. I mean, who knows if it's even true?
Yeah, yeah. And there was an article in the Wall Street Journal about it recently, and all over, it's been talked about a lot recently. So I don't know. I'm not sure exactly
how does that happen? I mean, basically, I think he, you know.
So essentially, he purchased I believe he had some pre-IPO stock that he purchased in the Roth IRA with a contribution. So he made a contribution within the legal limit, which is this year it's $7,000, or if you're 50 or older, it's $8,000. But he purchased some pre-IPO shares of stock, which appreciated a lot. I mean, incredible.
Tech stocks. Yeah, he's a tech angel investor, private equity guy.
Yeah. And so he just made some really great investments in it. And then, next thing you know, you got $5 billion in a Roth IRA. And I actually thought it was a typo. I had to do a double take.
Yeah.
It must mean million, that would still be a really, really, really great situation to be in.
Even if you can't get $5 billion into a Roth IRA, and we're going to talk about why Roths are great, but even if you can't get $5 billion in there, they're still an awesome thing.
Oh, yeah, yeah. I mean, having $100,000 or $5,000 in a Roth IRA is better than having nothing in a Roth IRA.
Just remind viewers of what makes a Roth IRA different than a traditional IRA and why, what some of the advantages are, if you wouldn't mind.
Yeah, so traditional IRA is kind of the original IRA. And so these are accounts that are designed for retirement, right? You make contributions, you can invest the contributions, and then it grows and it has tax benefits, but there are restrictions. It's designed so that you can't really pull the funds until you're sort of generally approaching retirement age, which is age 59 and a half for IRAs is when you can start pulling money out. But traditional IRA, how it works is you make a contribution, you take that contribution and you deduct it from your income when you go to pay your taxes. And so you save money on the front end in taxes. However, after you reach 59 and a half and you start thinking about taking the withdrawals, that's when you pay taxes, and you pay, as long as you took the deduction on all the contributions you made, you pay the full amount of your withdrawal. It's considered income, and you pay, your
whatever your
ordinary
tax
income
rate is. Yeah.
Yeah. Mm-hmm. So with Roths, it's kind of the opposite. What you do is you put money into the Roth that you've already paid taxes on. So you don't get any upfront tax benefit. And then you let that grow. And then, when the time comes to take your withdrawal, you don't pay taxes on the withdrawal. So the contribution and the earnings are tax-free. That's why this Peter Thiel's $5 billion Roth is so amazing, because if he pulls all that money out, he won't pay taxes on it.
So, you have to wonder why the government would think this is a great deal, because I don't think the government ever really gives us any real gifts, so to speak. And I tend to be a bit jaded about these things. I think that one of the reasons the government likes Roth IRAs, or in some cases Roth 401ks, is because they really want the tax revenue now. They want you to pay taxes right now, maybe when you're in your peak earning years, rather than waiting until later. And with a Roth, they get their money up front. They don't really worry. They don't have to worry about the tax when you're older, because it's not taxed.
Right. Well, and it's the same with an ordinary investor, someone who's saving for retirement. To some, they're going to value having the tax benefit right now a lot more than a tax benefit in the future. But others are thinking, well, I'm okay paying taxes now. I want to put money away and invest it aggressively and have as much after-tax, tax-free money down the road as I possibly can. I want to have that bucket get as big as possible so that I have plenty of control when I hit retirement. And if I need money, I can say, all right, well, if I take Roth, it's not going to affect my taxes.
Archie, it's a great thing. Roths are a great thing, but it's hard to get much money into them because you're limited in any given year. You're limited based upon your earnings, whether you're a participant in a retirement plan at work. And if you're eligible, the max you can put in, if you're under 50, is $7,000. If you're over 50, is $8,000 in any single year per taxpayer.
Right.
So that's one of the things that makes Peter Thiel's deal so extraordinary, is that he had to live by the same limits, those rules, but was able to grow something so big because he put his highest growth assets in the Roth.
Right.
But let's talk a little bit. How can you get money, maybe even more money, into the Roth than just what's provided for within those limits?
Yeah. So, of course, the just contributing directly is the kind of the main way, but you have those limits. Another way is, let's say you're just finding out about Roth and you've been compiling and contributing to a traditional IRA. Well, you can actually convert that to a Roth IRA. So if you, say, have $20,000 in a traditional IRA and you're like really sold on the idea, I want a Roth IRA, you can take that money and you can just, basically, you're just transferring it to a Roth IRA in what's known as a Roth conversion. You pay tax on the transfer in that year, but then that money is kind of scot-free for the rest of your life until you start taking the withdrawals, at which point those are tax-free. And so you've
How about
got
the money
yourself
that,
set up.
if you had a 401k at an old job and you roll that into a rollover IRA, can you convert some of that too?
You can convert that too.
Yeah.
In fact, you can actually, if your plan allows for it. So many 401k plans, of course, there's a traditional pre-tax piece where you're putting your income without any withholding before taxes into your 401k. Many employers allow for a Roth 401k, and so you can actually convert within the 401k to Roth. So you don't have to open up an account, a rollover IRA, and then convert from there. You can do it within the 401. Now, it depends on the plan. Not every plan allows that, but some and many, more and more.
Now, the plan will report that conversion amount as income, and you'll have to declare that on your tax return. You'll pay taxes on it when you do it.
If you've got $100,000 in your 401k and you convert that to Roth 401k, that's $100,000 of income that you're paying taxes on that year.
So you really
bump you into a higher bracket.
You really want to be aware of kind of at what point you might tip into a higher marginal tax bracket, right? So there's some tax planning that needs to go into this decision as well.
Yeah, into all these decisions, really.
Yeah, absolutely. So, how about if you're in a 401k at work and you're your earnings are in that phase out or above the phase out. And touch on the phase out first, and then talk about what you can do if you're above that level.
So the phase out that Rob's referring to here is essentially there's a big constraint on Roth IRA contributions. Basically, Congress said, hey, if you make over a certain amount, you can't make Roth contributions. And those amounts are indexed to inflation. But if you're single this year, it's $146,000 is where you start to phase out, and you can only make a smaller than your contribution has to be less than the max. And that kind of goes down through until you hit $160,000 in income, where you're completely phased out from making Roth contributions. If you're married, it's $230,000 is where the phase out starts, and $240,000 is where you're completely ineligible.
So you can't put money in a Roth. There's no way to put money in a Roth at that point.
Well, not exactly. If you can't make a direct contribution to a Roth IRA.
Okay.
Kind of the classic vanilla way. But there are other ways. So for one, if your 401k allows for Roth, those phase outs do not apply. So if you can make Roth contributions to the 401k, the income that's irrelevant. Not every plan allows for that though. So what if you don't have access to the 401k and your earnings are too high for a normal Roth contribution? There is another way. Now, this way, there are serious pitfalls that you have to really watch out for, and we'll talk about that. But this is commonly known as the backdoor Roth contribution. And what you do is you open up a traditional IRA, and you make a contribution, but you don't take the tax deduction, right? So you're just putting in money, it's been taxed, right? And then you convert that to Roth, right? So you're converting. Since you're not getting the tax benefit up front on the traditional IRA, it's not pre-tax. So the conversion isn't taxable, right? Except unless there's some earnings. So generally, you would do it in the same year, and you maybe would try to do it before it had a chance to really appreciate in value to avoid that taxation. And so what you're doing is you're getting money into a Roth IRA, but through a conversion rather than through a contribution. So it's a bit of a technicality, but it's a legal technicality. So that's one way to do that. Now, the big pitfall is something called the pro rata rule. And this is what gets a lot of people.
Listen up.
And it really affects it impacts the benefit of this. It makes it much less attractive. So let's say you have a traditional IRA, you've been contributing to it with pre-tax dollars, but your income is too high to allow for Roth, and you want to start making Roth contributions. So you do the non-deductible traditional IRA contribution, and then you convert. When time comes to pay taxes, you find out that conversion was actually taxable, and the reason for that is that non-deductible contribution is considered part of your entire pre-tax IRA, right? So they look at it all as one big thing.
Yeah.
And so they say, all right, well, if 95% of your IRA is pre-tax, we're going to consider that 95% of every non-deductible conversion is taxable, right? And it kind of boggles the mind, and it's confusing, and so this is why it can trip people up. So there are other ways, right? A lot of people will just convert their traditional IRA first, and they'll do that, and then they'll do the backdoor. There are other ways. I mean, but we won't. It's a little outside of the scope of today, but that's something to watch out for. That's a way
talk to your financial planner. If you don't have a financial planner,
absolutely
send us a text message or give us a call.
Yeah.
The
The other pitfall is you have to make sure that you're documenting that the contributions that you're making that are non-deductible are non-deductible, right? There's a form that you file, talk to your tax advisor or your tax preparer. Make sure that that form is filed when you make those non-deductible contributions. I would say we've got maybe time for one other important one.
Do you want to do mega backdoor since we've talked about backdoor? I mean, is there time to do that?
I think we can.
I just love the name. If you like backdoor, you're going to love mega backdoor.
Yeah, it's just a bigger version of the backdoor. So it's the same idea, but it happens in the context of your 401k. Your 401k has to allow for this process. So that's something to talk to your HR people about. If your 401k allows for after-tax contributions, and I'm not talking about they have a Roth 401k, I'm not talking about if they have pre-tax 401k, that's separate. If it allows for after-tax contributions, and it's an after-tax 401k, you have much higher contribution limits. So you can get up to $69,000 in there between your contributions and your employer's contributions, right? And it also would include if you're making contributions to the other buckets.
So you're saying you can put after-tax contributions over and above the other limits,
Mm-hmm.
and then that money can be converted to a Roth?
Yes.
Wow. That's an end run right there.
Yeah. The thing is that there's a lot of things that the plan has to allow for, right? It has to allow for after tax. It has to allow for Roth conversion, right? So you've got a lot of moving parts that you have to make sure are allowed in the plan. But it can be probably the most powerful way to get money into Roth in any given year because the limits are so much higher. But it's really important to talk to a financial planner about it. Talk to your 401k provider and plan administrator.
If you're watching or listening to this and you own your own small business, no brainer.
Yeah,
no brainer.
Yeah. Another one is this Roth Solo 401k, which is if you're a really small business, you don't have any employees, and you can open a Roth Solo 401k. The limits are really high for that as well. But you can't have employees if you do that.
Archie, I feel like we've hardly even scratched the surface on this.
Yeah.
We're going to need to do another episode, but we're running out of time.
Yeah, this is a lot. So we can certainly do another episode talking about, Roth and tax buckets and all that. But if this episode is useful to you, you enjoyed it, or if you have questions, let us know. Give us a call, 304-876-2619. You can also text us. Leave us a comment on the YouTube comments.
Like us, subscribe, tell your friends and family.
Yeah, hit the like button, set up notifications so you know when we release new content, which we do every week, most days of the week. And then we hope to see you next time. You've been watching Last Paycheck, weekly wisdom to help you retire and stay that way. If you like this show, be sure to hit like and subscribe. Last Paycheck is available anywhere you get your podcasts.